This episode is brought to you by Progressive Insurance. Fiscally responsible, financial geniuses, monetary magicians. These are things people say about drivers who switch their car insurance to Progressive and save hundreds. Visit Progressive.com to see if you could save. Progressive Casualty Insurance Company and Affiliates. Potential savings will vary. Not available in all states or situations.
For over 50 years, Burlington's legacy has been great deals on coats for all weather conditions. So before you're caught unprepared for the winter weather, head to Burlington for name brands, quality items, and surprising fits for every family member. Stock up on coats, sweaters, and accessories before the cold hits, so you can finally stop avoiding the elements and start living comfortably. Warm up at your nearest Burlington location less than 1 mile away. Burlington. Deals, brands, wow.
Welcome back to another episode of Investies. I'm your host, Linda Garcia. I am finally back in Dallas. I have been in Austin for approximately 12 days. I went for new member orientation. I had 2 fundraisers, and then all of a sudden I was swept into one of the most I don't even know how to describe it. Honestly, it was like something I had never experienced before. We are moving through the process of a speaker's race in the state of Texas. Donald Trump Jr. has inserted himself into the conversation in hopes to embolden the MAGA side of the Republican Party. I have been in emergency caucus meetings, on phone calls, in text messages. I mean, it has been nonstop communication from the time I wake up until the time I go to bed, unlike anything I have ever experienced. We are still moving through the process, and so I don't want to talk too much about it because, well, we're moving through the process and everything is changing minute by minute, hour by hour. But I am excited to be here with you today. And while we don't have necessarily a full episode on the market or the economy, we do have a conversation that you haven't heard before. This was a conversation that I had with Latin Wealth at their panel over the summer. I think it was over the summer. Yes, it was over the summer. And I can't wait for you to listen to this great conversation on investing in the stock market. I shared a panel with some other extremely intelligent folks. If you haven't heard Latin Wealth, it is a podcast. I highly recommend that you search for it on your podcast player and give it a listen. Before we get into that, though, I do want to give you some updates on what is taking place in the market. We are seeing new all-time highs on the NASDAQ, the S&P 500. I mean, the stock market has been on fire and it hasn't stopped. The record-breaking numbers have been continuous. A few updates here before we get into this week's episode. We did receive CPI data. As a reminder, CPI data is Consumer Price Index that measures inflation. In the data this month, CPI increased by 0.3% for the month of November. This is in comparison to the month of October. In October, CPI was at 0.2%, so we saw a total increase of 0.1%. What does this mean? This means that we are seeing an increase in inflation. We are seeing an increase in inflation. However, the market is okay with this because it did meet analysts' expectations. Analysts were expecting for CPI to increase by 0.1%. It was expecting a 0.3% for the month of October. And then if we look at this year over year, we are looking at CPI at a 2.7% increase. This means that inflation is still sticky, and this is why I was so adamant on not wanting Fed Chair Powell to drop interest rates, because inflation is still sticky. Now we are seeing all of this influx of money come into the market, both in the stock market and also within Bitcoin. And these types of increases in the markets also contributes to inflation. The market is pretty sure that we are going to see another decrease in rate cuts, which absolutely blows my mind. I will be shocked if Fed Chair Powell actually decides to decrease the interest rates, not for any other reason other than I think that that is a mistake. While a lot of us are getting to benefit from our portfolios, both in Bitcoin and in the stock market, remember that there are folks that are in lower income communities that do not have the resources to build portfolios and are being affected by the increase in costs. Investies, enjoy this week's episode on a conversation on a panel at the Latin Wealth Summit over the summer.
I know I've introduced my family to investment portfolios and they're like, I work really hard for my money. Why am I going to risk it if there's a chance I might lose it? I'm getting some head nods. So yes, right? A lot of us feel that way. Hopefully our next speaker is going to help us with that. I want to introduce us to Carlos Antonio. He will be our panel moderator for our next session. He is a data-driven business leader who's led global go-to-market strategies and launched cutting-edge products. He's also a Latino Puerto Rican living in Houston, so thanks for making the trip down. And today he is a spatial computing leader and part of Meta Strategic Partnerships team. You are all in great company, and it is my pleasure to introduce you all to Carlos Antonio.
I appreciate that. How's everybody feeling? Yeah? Well, you're in the right room because I'm just going to be kind of teeing things up for our experts who I'm super excited to have here. Quickly, to follow up on the intro, I'm a business leader, entrepreneur, and board advisor. So I've figured this out along the way. But being in this room is probably going to be the most impactful way to get started, right? We're going to bring some experts who are going to help us kind of talk through strategies, what asset classes look like, and ultimately how to get started today, right? So it's all about building a strategy, whether you're a novelist, you're intermediate, or you've been doing this for a decade. It doesn't matter. It's about getting started. So with that said, I want to bring out our two panelists that are going to be with us today. Give up some mad props and kudos to, first we've got Jeremiah Ramirez. We also have Linda Garcia. So if they'll please join us. So I first started by just saying your name because I would love for you both to introduce yourselves, give us a little bit about your background, and tell us why you're on the panel today. So Linda, if you'd start.
Hello, everyone. My name is Linda Garcia. I am a published author. I wrote a book called Wealth Warrior, 8 Steps for Communities of Color to Conquer the Stock Market. I have a podcast on economics where I educate marginalized community members on understanding what is happening in the economy, break it down in like 10 to 20 minutes every single week. I worked at Netflix in operations where I was able to advocate for Spanish subs and dubs on the platform, which is something that was really challenging, believe it or not. But I finally got it done there. And I've worked in Hollywood. I launched one of the first Hollywood major Latino movie studios, the first one. So now I'm running for state representative.
Clap that.
I am unopposed, so I will be a state representative here for House District 107. Thank you. In Mesquite, Garland, and Pleasant Grove, and sort of looking behind that curtain and bringing the information back to the people. So
Amazing. Thank you, Linda. We're excited to have you. Jeremiah.
Jesus, I don't know how to follow that. Congratulations, by the way, officially. And myself, this is year 11 in the financial industry. I started off with just seeing not a lot of people like us, obviously, inside of the financial. And by that, but I mean, like, people think of stockbrokers and things like that, but really all it is a certification. And so I was at 20 years old, had 3 different certifications, Series 6, 6, 5, 7. I was going to get a 2.6. I decided to go against that. I ended up, family happened, however, whatever, ended up going into chemical engineering. Now, a lot of people are like, what does that mean? I've started plants for top 5 chemical companies, DuPont, Mitsubishi. We've also done Oxy. And that led me to understand about finances and how the interplay between business and industry, and how a lot of people don't understand that a lot of the decisions that these companies are making inside of the boardroom are actually affecting you and your investments. And so went back to the investment side of things and said, hey, I need to actively start helping people with understanding the way that this is functioning. Started up my own brokerage. This is year 5 for that. Took it from 0 to now we're a 8-figure company. That's a blessing, but it needs to be more of us. And so obviously that's why we're here, and the inspiration that we get from people like our panelists. So it's, happy to be here.
Love it. So I appreciate everyone sharing their level of comfort with finances and how do we kick off this conversation. So I first wanted to start off by asking both our panelists, what does generational wealth mean to you, and why is it important for our community? Linda?
Sure. So for me, generational wealth, first and foremost, is about knowledge. It's about understanding our scarcity mindset and our limiting beliefs. I am a firm believer that it doesn't matter how much financial literacy you take in. If you're not addressing your personal relationship, your money stories, your money wounds, then you're not going to be able to accumulate. It's the same reason why people win the lottery and then they file for bankruptcy a few years later, because they're not mentally prepared to understand how to not only receive money, but manage money and help multiply money. Money is something that thrives when you put out and invest it and multiply it. That's where money is the safest. But we are accustomed to believing that if it's not in our pockets, in our banks, then it's unsafe outside, in the outside system. And that is so far from the truth. So for me, generational wealth definitely starts with the understanding. I have seen the difference between both of my children. I have a daughter that's 29 years old and then my son that is 8 years old. And I can see my daughter having to move through money wounds and scarcity mindset alongside me, where my son at 3 years old is like, people just need to invest in the stock market. And he was learning by osmosis. And so I believe that generational wealth starts with the understanding on how to not only receive money, but learn how to multiply it.
You mean abuela can't put it under the mattress, and
especially not with inflation.
Doesn't compound under the mattress, huh? Okay. Jeremiah, what does it mean to you?
Honestly, I think that generational wealth is it's a colloquialism, right? So it's just something that people say, and you hear it said by a lot of different people. But to me, people need to understand that also, as she said, it's a mindset, it's an energy as well. The energy that you protrude and the energy that you project out, like yourself and how you live. People live impoverished. You could be broke, right? And broke is just a temporary state, but impoverished is a mindset, and it's an energy that you emit. And unfortunately, in a lot of different communities and places where we are, we hear generational wealth, but we don't know what it means, because the energy and what protrudes around us is nothing but impoverished energy, right? And so I think if we actively start to focus on what it means for me to have generational wealth for me and my family, whether that be establishing some estate planning, Don't have to be rich to have estate planning, right? But establishing just very simple steps to create that positive energy for you and your family, and then I believe it will start to go a little bit further out. And I know it's a long answer, but it's because I think we hear that a lot. But like she said, the mindset isn't in the right place to actively receive the money that you're asking for.
Absolutely. I'll just say my 2 cents on it, that it's about intentionally empowering your family and those that come after you. And so Jeremiah and I've had many conversations on this, and, having that 7-generation mindset of how are you going to be the one that breaks the mold, and having that mindset, that intention, and then that spirit about yourself and carrying it. So that was the tee up. I want to get into some little bit more specific questions. And so I'll start with Linda. What investment principles or strategies would you recommend for Latino investors seeking to build a diverse portfolio and achieve long-term generational wealth?
So for me specifically, I consider myself an advocate for the stock market. Obviously, I think we need to be diversified in other areas, but only 15% of Americans are invested in the stock market. Only 15%. A lot of people feel like they're invested because they have a 401k that has exposure to the stock market. But when we are talking about direct ownership of stocks, we're looking at only 15%. When we look at our Black counterparts, they're 1.1%. When we look at the Latino population, only 0.5% are invested. Out of those folks that are invested, 90% of them are white, and they are the top 10% most wealthiest people in this country. We are, everything we consume, for the most part, that is mass produced is created by a publicly traded company. So a lot of people will say you can't invest into the stock market because it's so risky. But none of us go file in line to get our Apple iPhones and think, I don't know if I should make this purchase because it might be risky. We understand the product. We understand the value the product creates for us. And so it's important for us to start changing our mindset from a consumer mindset to become an owner mindset. So for me personally, that's what I like to advocate for, is explain how the stock market works. I am a long-term investor, so very similar to Warren Buffett. I like to look at things from a long-term perspective. A long time horizon is what we call it, meaning that I want to stay invested in a company. For me, the short term is 10 years, and I'm looking to ideally pass on the shares to my children, which is an important strategy that a lot of wealthy people do, which is buy, hold, and die. When you die and you pass on the shares to your children, there's no taxes that have to be paid, which taxes is one of the biggest liabilities that we have. So that is what I like to focus on. I think it's really important for us to start to get really comfortable with the market. I also think, I have a feeling that maybe there's a lot of folks in here that might be, entrepreneurs. I truly believe that by me diving into the stock market and paying attention to earnings calls, which is a quarterly call that happens from a publicly traded company where they give you all of their financials. You get to listen from the CEO, the CFO, and the COO of people that are really navigating how we live our lives day in and day out and are forward looking. When we start listening to those calls and looking at their financials, we really start to understand business from a completely different perspective. So acquiring the knowledge of a publicly traded company is not just going to benefit you in diversifying your portfolio and investing money, but it's also going to help you understand business on a completely different level. And I went to business school, and one of the things I always say is, if I was a teacher, I would 1000% make my students pick a publicly traded company, listen to an earnings call, look through their financials, and begin to understand the companies from this perspective. And then I just want to share one other thing is, I started investing in Netflix in 2012. When I started investing, the shares were at $23 a share. I was so terrified to make this investment. I only invested $200 a month. After my first year, I got to see my investment double. And I was shocked that there was this space where I could put my money to work and I didn't have to lift a finger. My mom cleaned houses for a living. My dad worked in the restaurant industry. So all I've known my entire life is a hustle. And all I have executed my entire life is a hustle. And so I felt like, no, this is the real hustle. Like that's a hustle. You put your money in an investment and it starts to multiply. I invested a total of $9,000 over the course of 3 years. And those $9,000 over the course of 8 years turned into $500,000. And so that's the specific area where I like to focus on.
Just to put it in context, it was trading at $20,
Yes.
right? And I believe they hit an all-time high recently of 6 and change.
7:30.
Thank you. I haven't checked it in a while, but
Friday, 7:30.
$20 is now worth $7.30. Time is your friend when investing. And so if you're playing the long game, she just gave you the game. Thank you. That was a phenomenal answer.
Time to play Best Fins, a match game with a zest. Among millions of players, can you become the best? No need to invest. Your free download awaits. With 9,000 levels, you'll be quite impressed. No Wi-Fi needed, just be our guest. At Best Fins, you'll be gaming at your best. Download Best Fins for free now. No need to wait. Wait? That doesn't rhyme. Never mind. Download Best Fins, it's great. Available in App Store and Google Play.
This one's for Jeremiah. How should Latinos consider allocating assets across traditional and alternative investments to optimize returns and minimize risk in their portfolios?
So first and foremost, you have to kind of define what is traditional. That's a mindset thing, or that's kind of subjective, right? But usually if you're thinking traditional, you're thinking about commodities based stuff, right? So you're thinking oil, you're thinking timber, things like that, building materials and things stuff that a lot of people don't even think about. And then also when you're looking at how much money that you look to allocate, I like actually what she said, which is on a bi-weekly basis when you're actually getting paid, put that money into something that you can actively see grow. And this is a whole nother side of things, but that's just dollar cost average. But that's just making sure that you can actively grow your investment and allocate it into things that you see are worthy. I tell people when I sit down with them, like, hey, give me 5 companies that you're interested in, 5 things you're interested in, whatever that is. And some people, I like shoes. Okay, so that's Nike. Electronics, it's Meta, or it's going to be Apple, right? Give me those 5 things, and those 5 things, I know that you're going to actively check behind those. You're going to look on your phone and you're going to check those tickers because you're actively wearing them, or this is something that you do. So you're going to look, you're going to pay attention to whatever they're doing inside of the market. That's one of the strategies that we have. Also, particularly for Latinos, a lot of the stuff, we're very food based. So if there's something that you like and something that you grew up on, or some type of food, I know for us Puerto Ricans is Goya. Okay, so go invest in Goya, right? These are just things or thought processes of how you live your daily life. Why not make money off how you live your daily life, right? And then finally, an allocation or a side of things that I would say to risk mitigate. A lot of people don't even think about this, but she's brought up Warren Buffett. Warren Buffett is particularly interested in indexing, right? This is something that he made famous. Now everyone knows an index. And most people know S&P 500, but there's actively insurance policies, life insurance policies, right? And a lot of people don't know about this, but they may know about whole life, but they don't know about something that's called an index universal life policy. What it has is a floor. So I get some of the similar advantages of what she's speaking of, which is the upside of the market, but then it has a floor of 0. So basically, when the market starts to have a volatility occurrence, right, I'm not going to lose any money. I stay at the spot where I was at my last gain. And so if you want to risk mitigate, you may not have the gains like obviously you would directly investing into the market, but that's the way to get a lot of the gains and then eliminate a lot of the risk as well.
Love it. And I think as you build out your strategy and you're diversifying, you start looking at these other areas where you can allocate resources and it has secondary, third benefits. And over time, those are all building towards that long-term plan. So moving to another question, and I think this one really speaks to what Linda was saying. Considering the unique economic and demographic landscapes of Latinos, what role should emerging market investments such as impact investing, or sustainability play in a diverse portfolio? How should we be educating and looking at these other areas outside of your just traditional 401ks or just putting money in a stock market?
Yeah.
It's funny because actively, in being a chemical engineer, I was sustainability manager as well. And so what you started to see was the rise of, your ESG type funds and things that are more environmentally friendly. And so the corporate attitude toward being environmentally friendly started to change, and that shifted. You see the government obviously starting to give huge tax incentives to these companies. And so I would tell people, you need to start learning about, actual building science, right? How homes are built. It's an actual science of how homes are built because they're actively building homes now to be more efficient and energy wise. You need to start learning about renewable energy, right? If you have a business, then your business, maybe you think about investing in other businesses that are in renewable energy. That's solar, that's wind. There's carbon capture as well, something that I'm actively doing some consulting on right now, which is carbon capture. All of these things all come into companies, and companies are now eating it up. Obviously, we know hydrogen is super, right? That's supposed to be the next thing or whatever. We've had electric vehicles. Now they're going toward hydrogen, green hydrogen. So all of these are emerging technologies. And with AI, obviously you and me always talk about it, but with AI being what it is, and that's starting to get integrated into these type of technologies that are emerging, you need to start studying those things, because a lot of the traditional things that we know, I don't know how gas is still here, but I don't know how long it's going to be here, right? But eventually we're going to be transitioning to something different, right? Fossil fuels, that'll start to move away. As an example of that thing, something to think about, there's a company that I invested in, that they're a utility company in Puerto Rico, but they're not doing utilities in the standard way, what most people do it. They did renewable energy, so it's solar, right? And it's a co-op, and so they own a piece of this solar farm, and the solar farm was developed and has relationship with Tesla. Now Tesla is giving, obviously they want the tax incentives and stuff, but Tesla's now getting money to better or impact a place that if you don't know, in Puerto Rico, there's always power issues. It's rolling blackouts all the time. And so now you're making an impact investment, and obviously that looks good for them on the optics. But it's just better overall impact wise. And I said all that to say the sustainability is something that everybody needs to be paying attention to, because it's reaping benefits. I was looking at an index the other day, and I was comparing it to the S&P. This index is S&G Micros. Credit Suisse owns it. And it's literally, it had done 3.5 times what the S&P's done year to date. So these are just things that we need to start looking at. And there's always space. There's always ways to get in. I mean, someone told you 3 years ago, hey, invest in NVIDIA. There were some people saying it, but you were there. See, I got money in it as well, because I heard Ian say it. So I was like, yeah, I'm going to go do it. But not too many people did. And so this is the same way, and this is the same horizon that you're starting to see with the sustainability movement. If you start reading about it and researching what companies to actively invest in now, it'll reward you. It's the Netflix, right? Netflix back in 2012. So yeah.
Love it. Yeah. And I think as you're looking at the social good aspect of it, it's about betting on humanity and betting on our society moving in the right direction. Because to your point, when ESG was a thing, it was greenwashing, right? They were just putting it in whatever they could, right? So that people would pick up the buzzwords, or they would get the sound clip. But ultimately, there are people that are out there looking at solving some of these very complex problems. And it's about how do you get in early, right? And continue that long-term outlook. So really, really insightful. And the NVIDIA piece, wow. I'll tell a fun story. I've been doing XR, we call it XR, but the metaverse stuff for over a decade. And there was a dependency on that early on. You had to have a high processing power GPU to be able to provide the graphics and the experience. And so I was already interested and invested. So I started putting money into it. And funny enough, then I would, at the time I managed retail partners, and I would go to those stores and they would be sold out of GPUs. And I was like, what is happening here? And they're like, oh no, the miners are buying it all up. And so then I realized that there was multiple dependencies on this one thing, and that commodity was going to have much more power in the future. And so those insights led me to have, 4-digit returns on what was, a minimal investment initially, but over time, that dollar cost average continued to build up. And to me, it's one of those where you don't have to get them all right, but if you get a few, it's rewarding. So, thank you for the insight there. For this one, I'd love to talk a little bit about it, because you talked about it's investing. It's you mentioned how you invest, you build, and then you die, right? And that's all part of a tax strategy, right? So this one is tying it back to taxes, and I'd love both of your take on this. What tax efficient strategies or vehicles can Latino investors utilize to preserve wealth across generations and minimize their tax liabilities?
Well, I think just, from a simple perspective, it's important for us to understand the difference between earned income taxes, how much we pay on taxes from the money that we make at our day-to-day jobs, and how much we pay in taxes from our investments. Those two tax brackets, those two numbers are completely different. And so it's important for us to understand that when we sell stocks and the profit that we make from the stocks, the amount of taxes that we pay on those dollars is significantly less than the amount that we're paying in our day-to-day earned income. And a lot of the times, I think for the most part in our communities, one of the biggest things I hear is, I don't want to invest because I ain't trying to pay taxes. And that's so wild to me, because we never think, I'm not going to go to work today because I don't want to pay taxes. And really, that should be the thought. I mean, really, if we're looking at the amount of taxes that you pay for investing versus the amount of taxes that you pay just to earn a living wage, it's that different. We should be thinking, let me start a business so that I can use different types of tax strategies and not be paying as much. So for me, it's just very simple advice in the sense that I want you to understand, especially the younger we are, when we aren't making a lot of earned income, there's potential to pay zero in taxes from the amount of profit that you may make on the stocks. So
super helpful. Jeremiah, what are your thoughts on this?
Of course, capital gains, just as you said, capital gains are going to be way cheaper than earned income. But I also think that people should start to understand different vehicles. If you're mid-age and you're accruing a massive amount you have a great stock portfolio, it's diversified, you own businesses, you own assets, you own gold, whatever it is that I need people to understand that, hey guys, when you pass, if you're not passing it on, and you should be properly, but you need to start learning about vehicles such as trust, right? And how to adequately have them own the stuff that you own. So now you're not owning it. You control it, but you're not owning it. And so that's something that we highly focus on, because a lot of people don't understand that you can amass all of these different assets, but when you die, a lot of it is a part of your estate, right? And the estate pays taxes, right? And so the focus for a lot of people, what I tell them is get that to a place to where it can be controlled and be passed on, either in a death benefit or either in a gift, right? but it's structured properly so you can avoid those taxes and mitigate them as much as possible. A lot of times people don't understand, especially in businesses, if you own a business, paying a massive amount of taxes is a choice. And they're like, well, what do you mean by that? Because, well, everyone talks about Trump. You talk about all these other Bezos, all these other business people because they don't pay taxes. No, there's loopholes. You need to just learn the rules. You don't want to play the game. And so you're losing the game because you don't want to play the game. And no, actually, if you're in the game, learn the rules, right? So I tell people all the time, if you paying taxes is a choice because you can always start a business, right? Start an LLC. That LLC could own a lot of different things and you write that off as a business expense. Or you can claim negative for maybe if you have inventory or you're moving. There's multiple different ways to mitigate the taxes. But if you're lazy, you'll never do it, right? So if you're lazy, you'll just keep paying a massive amount of taxes, right? If you're lazy, you're never or lazy or complacent, then like she said, you want to go to work and pay a massive amount of taxes when really you should be trying to figure out how to actively invest. And if you have to sell it, you can sell it. Also, utilizing what Linda said as far as the stocks, people also need to learn about collateralization, right? You own a massive amount of stocks and you don't want to sell them and pay the taxes on those stocks. You can go to banks and there are people that will sit down with you and allow you to borrow against the value of that stock. And then you can go put that into another investment that makes more money and then you're paying off the taxes from the other investment. Now you got two income streams from the same dollar. Right. And so that's another way, something else for people to think about. It's thinking outside of the box. If you stay just straight lined and always thinking about just what's put out there in public, right? The propaganda, they call it, then yeah, you're going to always pay taxes, but there's ways to mitigate.
Let's double down on that really quick. Talk about arbitrage. How important is that when you're building and you're stacking?
Oh man, arbitrage is everything because this is what the banks do. And a lot of people don't realize that, you put your money into the bank and the bank says, okay, I'm going to give you 0.01% interest, right? You don't even see it. It's a penny and then they want half of that penny. But okay, they're going to take that penny. But on the daily, the banks are doing interest sweeps on a daily basis, making money off your money. Now they're making 9 to 10% off your money as they invest, put it into life insurance and all kinds of things to do with your money. But daily they make money, right? And they're giving you a couple pennies. Now let's give an example. That same $10, say you had $10, took it to the bank, put it in your account. Someone could come behind you and say, hey, I need $10. I need to borrow $10. Okay, we'll give you those $10, but we're going to charge you 18% interest on borrowing your $10. And then you come back and say, okay, well, I want to take my $10 back and my interest, but you've only earned 0.001%, right? Not even a penny of interest. And so we need to start thinking about what is arbitrage. Arbitrage is the distance or the delta between basically what you're losing or what you're paying out and then what you're gaining. In that example, because what you're asking about is that collateralization. If I'm collateralizing or have a loan against my stock, my total stock amount, I may have to pay back that loan at 4%. Okay. But the stock itself I made 16%. So the difference, right? The delta between that is 12. So I'm 12% net positive. That's arbitrage. It doesn't matter. A lot of people don't want to put money in. You don't want to lose. I'm losing money, but that's that impoverished mentality, right? And arbitrage is for people that are thinking of how to make their money make money.
Love it. One thing also that you mentioned was having a trust, right? When you don't have a trust and you go to probate court, you're the last one paid. They will clear everything before they even think of you. But when you have a trust, you're putting your family first. And I think that's something that we should all be thinking about, talking about, and empowering our families to think, because, these banks, these creditors, they're going to get their money, but not from me. I'm going to make sure my family's paid first. So really, really appreciate that. Jumping into another question here, wanted to ask, we've seen technological advancements just hyperscale over the last 10, 15 years where this information, access to the stock market and to these equity markets is greater than ever. We're also seeing the rise in digital assets, which they play a part in your diversification strategy, right? But I'd love to get your perspective on just the scale that we've seen in the last decade around some of fintech and these products, but also what are your takes and strategies around digital assets?
I'm not really invested in digital assets, so I'm gonna,
maybe you could take the question on the fintech and just the platforms that have come and the accessibility, because when I was born, somebody had to call someone, they had to call someone, they had to call someone, right?
Sure.
And now it's more accessible than ever. So maybe take that part of it.
Well, I think it's important for us to understand the growth cycle of companies, where you have companies that are like embryos, they're in the womb. It's an investment that is a much more riskier investment. We don't know if it's going to go anywhere. We don't know if the sector will get regulated. So, investing in Netflix back in the early 2000 or in 2007, that was considered a massive risk, right? And then you watch that specific sector go into becoming a growth sector, where you have invested into the sector and then you see astronomical growth take place in a relatively short amount of time, like you said, 10 to 14 years. So we've been really lucky in the sense that we've gotten to partake in that wave of growth in the tech sector, where we've seen Google, Amazon, Netflix, Tesla experience massive growth. And I don't know how many cycles we get to see of that. Maybe you can explain that more to us as we're learning from Jeremiah. But one of the things that people tell me once we reach where we see massive growth take place is this still a good time to invest? Is this something that I should still be paying attention to, or should I be looking for the next best thing? For me personally, while I do like to be a little more, I guess, on the riskier side, that I do like to invest in tech, I think I'm considered more riskier just because we're looking at more of the old school investors like Warren Buffett that did not invest in tech. There's something called a PE ratio, with which a PE ratio is something that the easiest way for me to explain this and not have it go too over our heads is it tells us whether a stock is expensive or inexpensive. This is an old school mentality that I personally think is outdated. I'd love to hear your perspective on that. But Warren Buffett, if a stock had a PE ratio over 15, which meant that stock was 15 times valued more than it's worth, then he would not invest in it. And so based on this principle, he was looking for value stocks that were almost well past their growth stage, and what I feel headed more into a mature stage and towards decline. So he was investing in older companies. For him, the PE ratio of anything above 15 was extremely risky. That's why he never invested in Amazon. That's why he didn't invest in Tesla. That's why he didn't invest in any of the tech stocks. And it's so interesting to listen to Warren Buffett speak now, because I feel like he's finally realizing that he made a mistake. He just recently bought Apple, which he bought it after it had its massive growth. And so, I think that tech is everything, at least from my perspective. It's the future. I even feel like we're already behind on AI. When Elon started to create Tesla, for me, I immediately looked at Tesla as AI on wheels. I didn't look at it as a tech company. More so, I looked at it as an AI company. And I think we're still at the beginning stages, even though we've seen upward growth. Everything is priced for the future and where it's headed. But I would love to hear from your perspective.
PE ratio still sounds good because you're because you're always going to want to have a foundation.
And
right?
Do you think that a PE ratio, like, where's your base? What level?
Mine's is 10.
Really?
Yeah, I can't. And the reason I say that is because on the basis of stock and equities itself, I use that. Like, I'm more a commodity based person.
Sure.
And even how that links to tech, because I'm looking at iron. I'm also looking at different companies that foundries and things like that. Like, I'm looking at TSMC, because I'm more thinking about, instead of going directly to NVIDIA, I'm like, okay, let me go to the root of what feeds NVIDIA, and then I'll invest in that. And then that's just right. Exactly. Right. And so for me, it's 10, because that's more where I look to invest. Now, I do have some riskier things. My risk is obviously crypto. He knows this. Yeah, I'm a crypto person. But when it comes to like equities and things like that, yeah, but 10. And I, you know what? I say that, and then there's like EY Lilly, kind of, sure. Right? So then there's like these exceptions that have like long-standing success ratios, and so maybe for them I make an exception, but on a standard, yeah. But that's because that's how I invest, though.
No, yeah.
But to your point,
there's different
commodities, right?
Yeah.
Have already established.
Correct.
It's an established market, right? Now it's about consumption, the growth. There's an equation there that you can measure. Whereas in, you're looking at tech and some of these emerging markets, they're doing the Amazon model where they're not profitable. They're taking all of their profits and putting it back into the company. Yeah. So how long does the market sustain and vote on that is always risky.
It's true.
Yeah, it is true. I mean, when I first started investing in Netflix at 23, my accountant, which by the way, everyone should have a really intelligent accountant, because I don't do any of my taxes and we shouldn't be DIYing our taxes. I wouldn't do my own brain surgery. You need a brain surgeon to do that. So you want someone that's much more intelligent than you. However, I do take it with a grain of salt, because I feel like my accountant may have money stories of their own money wounds that, are impacting the decisions surrounding my money. When the stock hit around 150, he was freaking out on me. You got to sell this. You got to get out, because the PE ratio was way too high. Disney's coming in. They're going to have a streaming service, and then Hulu. But this entire time, Netflix was owning 35% of internet traffic, and Hulu and Amazon barely had 0.0 something. But to that, I just feel like he was extremely conservative from that perspective. And it really could have pushed me out of I could have listened to him, and it could have pushed me out, but I still feel like there's still a long runway, especially when I look at it from the perspective of when were these companies founded. And I compare that to blue chip companies and older investments that have been longstanding for generations and, generations to come.
True. And I think one thing to mention about PE ratios is that instinct that you had, right, led you to where it's at today to understand and envision. But had you listened to the accountant, you might have moved it to Blockbuster, just to give an example of the opposite, right? And
yeah. And also I wanted to say that, I think it's really important for us to understand, and you explained this really well, that we need to leverage our assets for more money. And that's exactly what Netflix was doing at the time. They weren't profitable until 2021 or 2022. For the first time, Netflix wasn't profitable until 2021. But what they were doing was leveraging their power, borrowing more money, and creating more assets. They were building their library. They were creating original content that was becoming worth more. And so from that's kind of how I look at it from that perspective, where I like to be low on my cash and use my stock portfolio as leverage to create more money. I think you want to see companies doing the same thing. And as a matter of fact, banks do too. If a company has too much revenue and cash, they won't lend that company money, because they can see very clearly that they're not reinvesting that money into the company and generating essentially more money.
Love it. Love it.
The #1 selling product of its kind with over 20 years of research and innovation. Botox Cosmetic, out botulinum toxin A, is a prescription medicine used to temporarily make moderate to severe frown lines, crow's feet, and forehead lines look better in adults.
Effects of Botox Cosmetic may spread hours to weeks after injection, causing serious symptoms. Alert your doctor right away as difficulty swallowing, speaking, breathing, eye problems, or muscle weakness may be a sign of a life-threatening condition. Patients with these conditions before injection are at highest risk. Don't receive Botox Cosmetic if you have a skin infection. Side effects may include allergic reactions, injection site pain, headache, eyebrow and eyelid drooping, and eyelid swelling. Allergic reactions can include rash, welts, asthma symptoms, and dizziness. Tell your doctor about medical history, muscle or nerve conditions including ALS or Lou Gehrig's disease, myasthenia gravis, or Lambert-Eaton syndrome, and medications, including botulinum toxins, as these may increase the risk of serious side effects. For full safety information, visit BotoxCosmetic.com or call 877-351-0300.
See for yourself at BotoxCosmetic.com.
Wanted to, before we open it up for questions, just wanted to kind of, Jeremiah, give us some information around these digital assets. How should people be looking, considering, and investing in that market?
First and foremost, you got to understand that there are, and a lot of people probably got into it, but there's like meme coins. There's pump and dump stuff that's out there, no different than GameStop, right? That happened in the market, right? But those type of things you honestly want to try to avoid because you don't know when that dump is going to happen. But do your research. They have white papers on every single coin that comes out, whether it's altcoin, whether, it could be DeFi, whatever it is. So actively do research, do your due diligence. If they're giving you the white paper, go and read the white paper. See what is the utilization on it, right? What is the tokenomics, we call it? What is the actual use for this? If it's BS, you probably don't want to invest in it unless you got some inside information that, they're going to run it up and there's this big whale that's going to buy it, right? If you knew Elon was going to Doge, right? He was going that type of stuff. But that's a 1 in a billion chance, right? That doesn't happen. So on a normal basis, when you're looking at cryptocurrency, let's just be honest, there's staples, no different than it is in the stock market. Apple's not going anywhere. Microsoft's not going anywhere. Google, Alphabet, they're not going anywhere. These are things you can invest in. You may not see huge gains, but they're not going anywhere. It's the same thing in crypto. BTC, Bitcoin, it's not going anywhere. Why? Because major companies and the banks have already bought too much of it. You can't get rid of it now because we own too much of it, right? And in Ethereum, for the point of what we call gas fees, all of the trades and things are usually indicated or they're created on that blockchain of Ethereum. So you have to pay in Ethereum for a lot of the different trades. XRP as well, which is a money mover. These are probably three coins, Litecoin as well. These are probably 3 to 4 coins that they're not going anywhere. If you want to start investing in those, or just start with Bitcoin, just simply start with that. There's a Bitcoin spot ETF, right? That you can actively invest in because that's what a lot of people were waiting on. And you saw the price of Bitcoin jumped because now they're saying, okay, there's a confidence in the corporate world, although there's always been a lot of confidence, but anyway, just start with Bitcoin, start with something simple, invest a little bit. Get you a wallet, whether it's external or you have it on your phone with a pass key, but get you a wallet that's separate from everything else. And then you can even do like dollar cost averaging. If you want to put a little money, put 20, $40 in. Every 2 weeks you're paid, put it into Bitcoin. That's it. And then I'm not the type, there's a lot of people that are going to come with all these different ideas. There's all these different coins, all that. Don't get lost in that. I mean, that's no different than anybody coming with the scam of the day. Right. Know where you're at, know what you're willing to invest, know your risk tolerance, know your risk capability, and then go along with that. And just to keep it super simple, if you're not into cryptocurrency at all, just look at Bitcoin, stick with that. You can ride that wave, and trust me, it's not over with. No different than she was saying, people are saying, oh, it's going to end. Nvidia's not over with either. As these companies and these things continue to grow, you just want to make sure that you get in. And there was a saying, and I'll pass it back, which is, when is the best time to invest? And it was 20 years ago and today. So, in 20 years, you would have said, I should have invested 20 years ago. So that's today, right? And so that's how I look at it.
Love it. Yeah, I think digital assets will become more prevalent in our lives. The utility of these digital assets aren't as clear to us, but it's very clear to the banks and some of those in the financial industry. So it's about getting ahead of when it's in your face, it's too late. And I think looking at that as your diversification strategy is important. So we're coming up on time, and I want to make sure we leave time for questions. Please don't be shy. There is no question, no bad question other than the question you don't ask. So I see some hands up. Anybody got a mic to pass, or here we go?
I don't think you guys prefaced the conversation with the strategies you're talking about are generally your risk bucket. So you didn't talk about anything about, hey, most people should probably just be into index funds, maybe some light real estate. But as you look at something that's maybe a little bit more risky, therefore maybe a little bit more enhanced return, this is where you can start to look.
Absolutely. Yeah. Talk a little bit about indexes and what does that mean? How does that spread the risk on your behalf?
I mean, right. She invested in, you said 2012. 2012, she started in Netflix, right? Now Netflix, of course, is a part of an index. An index is just a group of stock, right? And so you're spreading the risk. It's a great hedge tool. And that's why obviously Warren Buffett made as much money as he did. You know, he had the famous bet against the guys. You do yours for 10 years, I do mine. At the end of the day, winner takes all. And of course, Warren Buffett took all of it, right? I myself personally, I prefer indexing. When I'm speaking with clients, especially people that are not super affluent, but like I said, I'm going to walk them through the indexing through an IUL that I talked about, through the life insurance policy, right? And then so they can't lose any money. I'm going to talk to them about that and say, hey, what you're doing is you're hedging your risk. There's no volatility in this, and that's a better play. A lot of people like real estate, but then a lot of millennials, right? Us being us, we don't like the 4 to 6% return, and usually having to wait, and that's changed according to COVID and things like that with the housing market, and you got to look into that. But I think that from the aspect of indexing, you want to start to dig in, and a lot of people start with the S&P, NASDAQ, or the Dow, but NASDAQ particularly is probably one of the most popular because it's filled with all of the tech stock. And instead of you just going directly into Tesla and Elon having a bad day and being on some kratom or whatever he gets on, ketamine or whatever that because he has those days. And then the stock goes plummeting, right? Or he's just upset and he wants to focus on Twitter X more. Then why not invest into an index, right? To where you get the full growth of the whole sector instead of just worrying about if Elon has a bad day. Jeff Bezos is doing great, so Amazon's a part of that. NVIDIA obviously is going to push up the NASDAQ, right? These are all just a thought process. And so if you're not trying to be risk averse, because yes, we spoke about things that are pretty risky, but if you're trying to be risk averse, then indexing is obviously going to help with that. You're not going to see probably the massive growth that you would, obviously, but you don't have the risk either. And so you give that, and that all comes with, like I said, with your risk tolerance. You have to know what your risk tolerance is. If you're not a risky person and you're conservative in the aspects of your investments, indexing is the way to go because it kind of keeps you in that middle ground, right? You get a little bit of growth, but you don't have to worry about the lows.
I think just to add a little to that as well, it's really important that we, come back to ourselves emotionally as well. We have to really understand how to regulate our emotions when we are investing. So a lot of the times when we feel something is risky, more times than not, it's because we don't understand anything about the industry, the sector, or the security. Like we need to make sure that we are regulating our emotions and understanding that we need to educate ourselves. For us in marginalized communities, we have such deep scarcity that a lot of the times, I witness this all the time, when someone's investment is coming down and Elon does say something crazy, instead of freaking out, this is the time where you dollar cost average and you put more money into the investment so that, so we have to make sure that we are understanding that when we feel the risk, we need to pay attention to that. If we are really looking to become asset builders and create generational wealth, I think indexes are extremely important, but I also think it's important for us to understand the rate of return of these publicly traded companies and that we're participating for several reasons. The biggest one is because when we say, publicly traded companies, they only care about their investors. Damn right. Yeah. Yeah. You know why? Yeah, exactly. Because we see the CEO as being the owner. The CEO is just another employee. The owner is the people that are invested into that publicly traded company. So yes, the entire company is working to make sure that the retail investors are satisfied with the performance. So what happens when the majority of the investors are white? Yeah, they don't care about marginalized community members. They don't. But the more that we participate and the more that we are becoming majority direct stockholders, then we will begin to matter, because I can reach out to any of the companies that I'm invested in and question them on specific practices that I don't align with. And I can say, if they have to by law give me an answer or I divest. And so when we start to become the majority of investors, we actually hold power. As direct shareholders, we also have voting rights on these companies. And so this is why I like to promote, what some people may consider something that's a little bit more risky. And to me, I think it's about time that we start participating in this sector.
I mean, I totally agree with that. And I'm going to say something, which is a lot of people, me and Chris get into it all the time about this, but real estate's risky to me. And a lot of people just look at me and they're like, how? I'm like, well, I mean, for 50 years, maybe if you were fed something and told you that was the way to do it because banks made a lot of money off of it, right? I mean, and that's a thought process. But you can see now since 2008, and then it's happening yet again. Is it risky? Yeah. And so a thought process, like you said, that's very subjective. Like, what is risky? What does that actually mean? Does risky mean I just feel uncomfortable, right? Like I really don't know. I don't know much about AI, so that's risky. It's not. I mean, it's here. It's not going anywhere, right? But I like that, controlling your emotions, because like I said, and I go against people all the time, and they're like, yeah, real estate, I just invest in property. I was like, that's risky to me.
I mean, insurance companies are no longer insuring houses. So it's pretty risky to me.
Exactly. Yeah, 100%.
Love it. Another question.
So, hi, I did have a question. I know you mentioned on the strategies on how to invest. However, for example, for me, I'm a beginner. I haven't even opened an account. Who will be my subject matter experts? For example, what brokerage to kind of invest on? Because I know there's Ameritrade, there's a couple out there, but I just know one, and how to kind of utilize that. Once you create your accounts, you have like full ownership, and can you move that money at any time? And who would also be contributing to that when you're paying out like investments? Yes.
I'll take part of that, the first half of that question, and then the second half. But I have a book that is called Wealth Warrior, 8 Steps for Communities of Color to Conquer the Stock Market. The chapter 1 is all based on emotions, money scarcity, and dealing with those fears. Part 2 is understanding the taxes and those types of implications, and make sure that you're diversifying outside of just direct investing directly into stocks. And then it's very simple beginner level type investing for those that have never opened a brokerage portfolio. I go into the book and talk about how to open it step by step. It's a very simple way for you to get started from that perspective. And then what was the second?
So a lot of people are going to say, obviously financial advisors are there, and they'll help you to manage that. I think that the best way to do it, especially on a self-directed brokerage account like that, is to take the steps that she said, actively learn it yourself. Now, if you're getting into, there's levels to investing. And when you start to get into maybe you determine what that level would be, but let's say you get above $25,000 in a brokerage account, maybe it's something that, and you just had a kid, right? I can't actively look at this every single day. I need someone to help me or assist me with that. Then, and that's different places for different people. I can't tell you exactly where to go, but what I can tell you is your financial advisor should be able to provide you information that's going to help you progress in your investment, right? And it's hard because a lot of us don't know, especially in marginalized communities, we don't know the difference between if they're giving me advice to better their pockets or if it's advice that's actually going to help me, right? And what I would say by that is like I said from the very beginning, if you get 5 things that you like that you enjoy. And if you're invested in those 5 things, you know what the CEO is doing because you keep up with those companies. You know which direction that company is moving because you keep up with them. So if the guy comes and tells you, hey, sell, but you actively know, like, no, it's because they're acquiring another company. You're like, oh man, this guy, he's just trying to make money off of me. These are just things, and that's due diligence on our part. But each and every person has to set their limit when that level is, because it could be 10,000 for some people. They just feel totally uncomfortable. That's way too much money for me. I need someone to help me with that. For other people, it's $1,000. They don't, and so what I would tell you is set that limit, whatever that number is for you. And when you get to that point, based upon your life and what a life occurrences have occurred, life events, the time and the attention that you're able to pay for it, then that's when you want to start bringing people in. And there's no particular brokerage. There's good people in all different brokers. There's bad people in all of them, right? And so you just want to find someone that's specifically attentive to your needs and that they're going to help you get to where you want to go.
And then also don't get too overwhelmed with the bigger picture, because it's a beast, right? Like there's experts that will never get through the entire beast of it all. I mean, so for me, and I know it's easy to get overwhelmed, if you just take it step by step, like just open the brokerage account, decide, set your budget. And for me, I think especially as we're learning and we're moving into this space, a budget can be $20 a month. There's no shame in that. For me, the process is like, just get started so you can actually start to witness your own personal emotions. You can start to witness those $20 have gains, and you start to look at money from a completely different perspective. And then the next month, or maybe after 6 months, you're like, oh, I can do this. Let me do $30 a month. But all of this time you're moving through the market. The market is our teacher. Honestly, that's the real expert. The real expert is the market. And that's who we should be going to learn from, not necessarily another person, because as he mentioned, we all have our own agendas and wounds and things like that. But most important is to just get started.
Awesome. Next question.
Yeah. So similar in that same vein. So as entrepreneurs, right, one of the best things I think that we can do is learn to borrow against our portfolio. But when you're running a bunch of different businesses, I don't have time to figure out what him, her, there, who, no. Even though I feel richer just sitting here listening to you guys. What do you guys think about robo investors, investment platforms? So like Wealthfront or things like that, where it's like you can kind of automate your investing to kind of use that as a way to build a portfolio that you can borrow against as an entrepreneur and become your own bank, versus a wealth building strategy that is more long-term.
Yeah, I think I'll just share my perspective, and then I'd love to hear yours as well. I do think that I've never used a robo investor, but I think that with AI and the technology that we have, we might be able to ask robo investors really quick questions like a chat GPT and learn and have it make specific decisions. We're putting our trust into this machine to make decisions. I would really like to encourage folks, he says 5, which is great. I've never heard that before. I always say 3. I try to keep it as simple, like pick 3 companies, just as simple as possible, because you might think right now that you don't have time. First, I want to say that when you first start, it's going to take more time to learn the process. As you move through it, it's going to take less of your time, because you're going to know exactly what to look for and when you need to pay attention and when you don't need to pay attention. So the amount of time that you invest in learning how to invest and paying attention to your investments, I think becomes less as you get more savvy. This direct investment that you're going to make in time of learning this information is going to pay you more than the businesses that you currently have that have you mobilizing yourself and going back and forth. Like, if anything, this is the most important piece of the game we call life that we should be paying attention to, versus our own entrepreneurship. For me, I have created and pivoted so many times in my entrepreneurship. And the one thing, the OG thing that has stood by my side is my stock portfolio. That's the one thing that's not going anywhere. So.
So with the rise of quantum computing and AI and all that stuff, I actively got into robo investing, and we actively actually have one of the funds that we have a partnership with that have a robo investor, and it does pretty well. I would tell you this though, and I tell this to anybody that's looking to invest: let that be play money. Because at the end of the day, there could be malware, there could be. We're not above that. We're not at the stage to where it's, the Terminator and it's Skynet, where it just knows everything. I mean, it's getting there. Don't get me wrong, right? Because usually when you see things out in public, it's 10 years behind what it's actually been. So they've been using AI since like mid 90s. But anyway, so I would just tell you, if you're going to have a robo investor in somebody let that be play money, right? I'm definitely willing to like put in the time, put in the effort. I know a lot of people tell me that they're busy. They're not busy. They're just doing stuff. I'm not saying you. I know you're busy because I know what you do, right? But a lot of people aren't busy. So if you have that time, and if you have these businesses and these other businesses that you're building, I would tell you to just a lot of time. Schedule a time period when you're going to actively go look at your brokerage account. I'm going to spend an hour today doing whatever it was that you're going to do, whether it's reviewing your stop losses or reviewing year to dates or whatever it is. Okay. Take that time and schedule it into your day, and so you never miss it. It could be an hour every single day, Monday through Friday. Schedule the time in and do it, because I do agree with her. I'm never too busy to look at money, right? Now, sometimes I've cut off consultations and said, yeah, I'm not going to make that consult. And I'm not saying do that for your clients or whatever, but right? You still have to pour into yourself. And that's a part of pouring into yourself is I got to look at my stocks. I got to make sure that my investments are growing, because if all this fails, and if you as a client say, hey, screw you, and then all these clients tell me screw me, like she said, I can instantly go back and here I am, and I can borrow against whatever I've been building over here. And I know I've built a very strong foundation. So I'm in agreement with her. But if you're going to use it, just make sure it's not money that you'll miss.
Just to echo what Linda was saying, Jeff Bezos made most of his money from being an investor in Google, an early investor. So why don't we talk a little bit more about becoming an accredited investor and what that means, and then to participate in the private placement. And
well, I'm currently running for state representative, so
yeah. I was like, she can't comment on that. Yeah. So an accredited investor, that's the next step. That's the next level up. I mean, we're talking about, right, grassroots, so you're starting at the beginning, but the accredited investor is that next level up. And there's a couple of different criteria. There's metrics. It's 3 years. Basically, you got to be earning 3 years of $250,000 or greater, or you need to have a net worth. Now they just moved it to greater than $1.7 million. Okay. That's an accredited investor. That's somebody that's a little bit higher level up. And then you move from there to institutional if you're doing bigger things. But anyway, that should be a goal. I agree with you. That should definitely be a goal of everybody to get to that level, because that's when you're taking your investment seriously. Now, for people that are, I would say the accredited investment space, right, opens you up to so many more opportunities, because like I have funds, right, that unless you're an accredited investor, we don't even accept you into the fund. The minimum amount of money coming into the fund is $250,000. And to be an accredited investor, and I got to know that, you got to have your paperwork to prove that, right? Now this fund, the returns on this fund is about 37% year over year. Okay. You don't get access to certain things like that until you get to that level. If not, you're just still at the retail level. And I also feel like we need to see more of us. And the game and the attention that we pay when you get in those spaces and you start to have these conversations with people that built up, let's say a hedge fund, or became an institutional investor, or is managing money for a large group of people. The stuff that they see is on a different level than what you see at the retail level, right? A lot of the information and the news we get is kind of filtered and it's propaganda fed by the time it gets to you, right? Versus in these rooms, they're making decisions that determine what happens with you in your everyday life. And so you want to get to that level so you can sit at the table and you can actively see what's going on and make a better assessment of where you're going to place your money and how that's going to grow. Also, and accredited investing is something that I think that, well, I don't know. I mean, for most people, do you guys see it as like something that's super lengthy, like the metrics I gave you? Does it seem like that's something that's super far away? A lot of people, she shakes her head. So maybe if we start to give the steps, and this is something that I've been actively working on with my brokerage, is what is the steps to get me there? Like, what are checkpoints for me to actually get to that level? Because that's daunting. I don't know how to do that. I came from an area that no one knew how to do anything with investing. I'm the first of anyone doing anything. How do I get to that point? And so to have your book, which is going to get them to the beginning and get them right to that level, and then to take the hand after that and say, hey, now I'm at this level. How do I continue to grow and scale? That's something that our brokerage has actively looked at. So that's a good point. Thank you for bringing it. What's his name? I'm sorry.
What was your name?
Chris. Thank you, Chris.
Great question, Chris. And I wanted to piggyback off of that because it does seem like a high bar. And, as you go from retail to accredited to institutional, but you also have to realize that is risk tolerance. As you go up the chain, your risk tolerance has to be greater. And so as you're working and building your way up the ladder, just understand that emotionally you have to detach yourself from the risk. You have to be a smart investor, but you have to remove the emotion.
I would also say that, honestly, it is greater risk. But, I mean, if you're looking at the risk ratio on a lot of this stuff, as you start to move up, it starts to lower, actually. And then what ends up happening is since your gains are so much greater year over year, it ends up starting to be, right, it's actually more beneficial for you to take that risk than it would be at the retail level, right? Because now I'm not really, I put in $250,000, but year over year, we're almost doubling our money within a year and a half. Takes a while to do that, unless you hit a Netflix or you hit an Nvidia at the right point or whatever, right? But yeah, for sure.
Awesome. Well, I think that wraps us up.
Yeah, thank you so much. Can we thank our panelists and our moderator?
Thank you for listening to this week's episode. I'm your host, Linda Garcia. You're listening to Investies, a Cosmic Standard and In Luz We Trust production. A special thank you to the team, Asia Simpson, Eliza Smith, and Jacob Winnick.
The most wonderful time of the year. Although, let's be honest, around the holidays, things really add up. But here's the good news. Only at Verizon, you can get a single line for $50 per month when you switch and bring your phone. So while ice skating for two is definitely costing more, here at Verizon, you can save. Gifts for your third cousins? Steep. A single line with Verizon? Not so steep. A real tree? Pricey. A single line with Verizon? Less pricey. Flights to see Mima and Pops? Those are up. A $50 per month single line? That's down. Even a trip to the Atlanta Holiday Market will cost you more. But with Verizon, you can switch and bring your phone for just $50 per month for a single line on unlimited welcome, with autopay plus taxes and fees. All this to say, during the holiday season, when everything is costing more, you can get more for less right now at a local Verizon store. $15 monthly promo credits applied over 36 months with a new line on unlimited welcome. In times of congestion, unlimited 5G, 4G LTE may be temporarily slower than other traffic. Domestic data roaming at 2G speeds. Additional terms apply.